Hey everyone, welcome to today's session on assessing financial reporting quality. I'm thrilled to have you all here. As aspiring CFA charter holders, you know that digging into a company's financials is like being a detective. You've got to look beyond the surface. So why is assessing financial reporting quality such a big deal? Well, not all companies play by the same rules. Some are straight shooters, while others might be cooking the books. Our job is to spot the red flags and read between the lines. Imagine you're analyzing two companies in the same industry. On paper, they both look solid, but if one is using low-quality financial reporting, your analysis and forecast could be way off. That's why we need to be skeptical, critical, and always on our toes. All right, let's dive in. First up, let's get a handle on what we mean by financial reporting quality. High quality financial reporting is like getting a clear, accurate map when you're lost. It's invaluable. It provides relevant, complete, neutral, error-free, and decision-useful information. In other words, it paints a true picture of the company's economic reality during the reporting period and its financial condition at the end. On the flip side, low-quality reporting is like a distorted funhouse mirror. It misrepresents economic reality, making it harder for us to see what's really going on. Now, here's the kicker. A company with good performance might still produce low-quality reports. Why? Maybe they've got outdated internal systems, or perhaps they're being overly conservative to avoid unwanted attention or to stash away profits for future periods, what we call hidden reserves. For example, think about a company in a highly regulated industry. They might underreport profits to avoid drawing scrutiny from regulators or to keep competitors in the dark. Similarly, a new CEO might take a big bath in their first year, accelerating losses or writing down assets to set the stage for better looking results in the future. It's like lowering the bar so you can easily jump over it next time. Ultimately, earnings quality is about sustainability. High quality earnings are those that provide an adequate return on investment, meeting or exceeding the company's cost of capital, and are likely to continue in the future. Remember, even a well-performing company might have poor quality reports. This could be due to weak internal controls, deliberate choices to use conservative accounting methods to understate performance, or even hidden reserves to delay recognizing profits. On the other side of the spectrum, a company might choose to accelerate losses during the first year of an acquisition or under a new CEO to set up a more favorable future trajectory. All these tactics play a role in shaping financial reports, and understanding these choices helps you become a more skeptical and aware analyst. Make sense? Awesome. Now let's talk about GAAP and what makes financial information useful for decision making. GAAP stands for Generally Accepted Accounting Principles. Whether we're talking about IFRS or US GAAP, these are the rules of the road for financial reporting. Information is considered relevant if it's material and can influence decisions. It must also be faithfully represented, meaning it's complete, neutral, and free from error. But wait, there's more. There are 4 enhancing qualitative characteristics that make financial information even more useful. Comparability. We need to compare apples to apples. Information should be consistent over time and across companies. This helps users identify similarities and differences. Verifiability. Independent observers should be able to agree that the information is faithfully represented. It's like having multiple mechanics agree on what's wrong with your car. Timeliness. Information needs to be available when it's still fresh. No one wants yesterday's news. Understandability. The information should be clear and concise so that users with basic business knowledge can get it. No need for a decoder ring. Now, sometimes there's a trade-off between timeliness and accuracy. Getting error-free information might take time, but we also don't want to wait too long. Here's an interesting point. Even if a company follows GAAP and provides high-quality financial reporting, the earnings themselves might not be sustainable. For example, a company might report higher operating profits due to favorable exchange rates. While the reporting is accurate, those earnings might not last if exchange rates fluctuate. So always consider both the quality of the reporting and the sustainability of the earnings. Now let's tackle biased accounting choices. Biased accounting happens when companies make choices that skew the financial statements, making them not faithfully represent economic reality. This can mess with our ability to assess the company's true performance. Here are some examples. Aggressive revenue recognition. Companies might recognize revenue prematurely, resulting in overstated income, equity, and assets. However, this aggressive approach can lead to a reversal of fortunes in later periods when reality catches up. It's like counting your chickens before they've hatched, or worse, before you've even got eggs. Aggressive choices can inflate current performance but may hurt the company later when reality catches up. On the flip side, conservative choices like deferring revenue recognition can lead to understated net income, equity, and assets. This approach might reduce reported performance in the current period, but could improve future reports. It's like not counting your chickens until they've fully grown and laid eggs of their own. Conservative choices can make future periods look better, but might not reflect current performance accurately. There are also specific examples of conservatism in accounting, such as recognizing research costs immediately as an expense rather than capitalizing them, or recognizing litigation losses that are probable, even if they haven't been legally incurred yet. These are conservative moves that protect companies, but might not always present the most accurate picture of economic reality. Some companies also engage in earnings management or earnings smoothing. They might understate earnings in good times and overstate them in bad times to make their performance appear steady. It's like smoothing out the bumps on a roller coaster. For instance, a company might delay recognizing revenue until the next period or accelerate expenses into the current period. Now, all of this might be within GAAP, but it's important to question the motivations behind these choices. Think about tech companies that offer software subscriptions. Some might recognize the entire revenue upfront, while others spread it over the subscription period. The choice can significantly affect reported earnings. As analysts, we need to dig into these policies to understand the true picture. Within GAAP, but earnings management. Let's not forget that companies can manage earnings within the boundaries of GAAP. For example, they might defer R&D expenses to a future period or change accounting estimates like expected product returns or bad debt expenses to smooth out earnings. Even though these choices are within the legal framework, they can significantly impact a company's perceived performance and need to be scrutinized closely. All right, moving on to departures from GAAP. Now, what happens when companies stray from GAAP? What it means. This can happen in various ways, using non-approved accounting methods, omitting required disclosures, or misclassifying items in the financial statements. Financial reporting that doesn't conform to GAAP is generally considered low quality. If a company uses a non-GAAP measure in an SEC filing, they must report the closest comparable GAAP measure with equal prominence and provide a reconciliation. The SEC has strict rules to prevent companies from using non-GAAP measures to mislead investors. For example, they can't exclude charges or liabilities that require cash settlement from non-GAAP liquidity measures, except for EBIT and EBITDA. Remember the Enron scandal? They used off-balance sheet entities to hide debt and inflate profits, blatantly violating GAAP. We all know how that ended. Not good. Departures from GAAP can seriously mislead investors and other stakeholders. As analysts, we need to be on the lookout for any signs that a company isn't playing by the rules. Any thoughts or experiences you'd like to share? Let's take a closer look at conservatism versus aggressiveness in accounting. Neutrality is the name of the game here. Neither conservatism nor aggressiveness is ideal. Let's dig deeper into conservative versus aggressive accounting. In accounting, conservatism means recognizing potential losses or expenses promptly, but delaying the recognition of gains. It's like being cautious and setting aside extra money for a rainy day. For instance, under IFRS, impairment losses are recorded earlier than under US GAAP, making IFRS appear more conservative. However, US GAAP is more conservative regarding asset recoveries, as it doesn't allow a write-up after impairment. Understanding these differences is key to assessing the impact of accounting policies on financial statements. Conservatism in financial reporting can offer several benefits. It helps protect less informed parties in contracts by avoiding overly optimistic numbers, reduces the risk of litigation from stakeholders, and safeguards regulators and politicians from backlash due to overstated economic performance. Additionally, it can help companies manage their tax burden more effectively by lowering the present value of tax payments. However, while these benefits are significant, it's crucial to remember that financial reporting should aim to be neutral, providing unbiased and accurate information for all decision makers. Aggressive accounting, on the other hand, involves recognizing revenues and assets earlier or overstating them, and delaying or understating expenses and liabilities. In the lead up to the 2008 financial crisis, some banks used aggressive accounting by not recognizing potential loan losses promptly, which overstated their financial positions. As analysts, we need to understand where a company falls on the conservative-aggressive spectrum and consider how that affects the financial statements. Now, why would companies intentionally manage their earnings? There are several motivations. Meeting analysts' expectations. Companies might manipulate earnings to meet or beat market expectations, which can build credibility with investors and positively affect stock prices. Debt covenants. To avoid breaching debt covenants, companies might adjust earnings to look healthier. Incentive compensation. Management bonuses often depend on hitting certain earnings targets. Now, let's consider motivations to decrease earnings. Obtaining trade relief. Lower earnings might help in negotiating tariffs or subsidies. Negotiating lower payments. In mergers or settlements, showing lower profitability can be advantageous. Bargaining with unions. Companies might understate earnings to gain leverage in labor negotiations. But when companies face intense pressure to meet these targets, have opportunities to manipulate their reports due to poor internal controls, or rationalize their actions with excuses like, everyone does it, that's when low-quality financial reports emerge. It's like a perfect storm of incentives, opportunities, and rationalizations. This is often referred to as the fraud triangle. First is pressure or incentive. There's pressure to meet targets or expectations. Second is opportunity, weak internal controls or ineffective oversight. Third is attitude or rationalization. It means justifying unethical behavior. Everyone else is doing it, or it's just temporary. Consider WorldCom, which capitalized operating expenses to inflate profits. They had pressure to meet Wall Street expectations, opportunity due to weak controls, and rationalized it by believing they could fix it later. As analysts, understanding these contexts helps us be more skeptical and thorough in our evaluations. So, what keeps companies in check? There are several mechanisms. Several mechanisms help maintain high-quality reporting. Market regulatory authorities. These bodies set the rules for registration, disclosure, auditing, and more. They enforce compliance through fines, suspensions, and sometimes even criminal prosecutions. Auditors provide assurance that financial statements comply with relevant accounting standards. However, remember that audits are based on sampling and don't guarantee against fraud. Auditors are paid by the company, which can create conflicts of interest. They might not detect all frauds, especially if there's collusion. Private contracts, loan agreements, and investment contracts often contain covenants that incentivize companies to report accurately, or else face consequences. These mechanisms help promote high-quality reporting, but they're not foolproof. It's our job to look beyond the surface. Now, let's get into how we can detect issues in financial reporting. Companies might manipulate their financials by recognizing revenue prematurely, shipping products early, or changing terms to book sales sooner. Using non-recurring transactions, selling assets to boost profits temporarily. Deferring expenses, capitalizing costs that should be expensed. Overvaluing assets, inflating asset values through aggressive estimates. Undervaluing liabilities, understating obligations to improve the balance sheet. Understanding these tactics helps us be more cautious and critical when analyzing financial statements. Companies often present non-GAAP measures like EBITDA or adjusted EBITDA. They might exclude items such as rental expenses, stock-based compensation, acquisition costs, impairment charges, litigation costs. While these can provide insight, they can also be used to paint a rosier picture. During the dot-com bubble, many startups reported pro forma earnings that excluded many expenses, making losses look like profits. As analysts, we need to reconcile non-GAAP measures with GAAP. Understand what's being excluded and why. Consider the sustainability of these adjustments. Let's talk about how accounting choices and estimates affect earnings and balance sheets. Choices like inventory costing methods, LIFO versus FIFO, depreciation methods, and revenue recognition policies can significantly impact reported financial performance. For example, FIFO might show a higher ending inventory value in times of rising prices, but lower cost of goods sold, while LIFO might provide a more relevant cost of sales value. Straight-line depreciation spreads the cost evenly, whereas accelerated methods like double declining balance result in higher expenses earlier. Different choices lead to different financial outcomes, and it's crucial to know how these impact the bigger picture. As analysts, we need to read the footnotes and understand management's assumptions and choices. When it comes to cash flow statements, remember there are 3 sections: operating, investing, and financing cash flows. A startup might have negative operating and investing cash flows, but positive financing cash flows. In contrast, a mature company should have positive operating cash flows to fund investments and capital returns. If you see consistent positive earnings but negative operating cash flows, it could signal earnings manipulation. Watch for deferrals in payables, accelerations in receivables, or misclassification of cash flows to spot red flags. A company nearing the end of a quarter might delay paying its suppliers to show higher CFO. While this might look good in the short term, it's not sustainable and could harm supplier relationships. As analysts, we should compare net income to CFO. If net income is consistently higher than CFO, it might indicate aggressive revenue recognition or expense deferral. Analyze changes in working capital accounts for unusual trends. All right, folks, let's talk about something really important when it comes to analyzing financial statements, choices, and estimates. Companies make decisions every day on how to present their financials, and these decisions can significantly impact what we, as analysts, see on their reports. It's like a magician's trick. Sometimes what they're showing us is real, but sometimes there's some sleight of hand. Let's break down some of the key areas where companies' choices can affect financial reporting. Revenue recognition, one of the big ones. Companies can play with when they recognize revenue. Do they record it when the product ships or only when it's delivered? Watch out for tricks like channel stuffing, where they push more products out than needed just to inflate sales numbers, or sneaky bill and hold transactions, where they recognize revenue before they've even shipped anything. You've got to ask, is this real revenue or are they playing games? Depreciation of long-lived assets. This is all about how companies spread the cost of their big assets over time. If they change the lifespan of an asset, suddenly the expenses change too. And guess what? That impacts their earnings. Be on the lookout for recent write-downs because it could be a sign of something bigger happening with their assets. Intangible assets. Think patents or trademarks here. Some companies like to capitalize certain expenses like R&D while others don't. This can make a big difference when comparing companies. Also, you need to check if they're amortizing these assets properly or if they're dragging their feet to keep expenses down. Allowance for doubtful accounts or loan loss reserves. Essentially, this is how much the company thinks it won't collect from customers or borrowers. If they suddenly lower this allowance, it might look like they're doing better than they really are. Pay attention to how this allowance changes, especially if the industry is facing tough times. Inventory costing methods. Should they use FIFO or LIFO? This can impact how much profit they show. Also, companies sometimes use obsolescence reserves to adjust for old, unsellable inventory, but watch out for something called LIFO liquidation. It's a tactic they might use to boost earnings when inventory costs have risen. Tax asset valuation accounts. This one's about how they value deferred tax assets. Sometimes there's a contradiction between what management is saying in their reports and the numbers in this account. If they change their valuation allowance, it can have a big impact on net income. Always check if that change makes sense. Goodwill. Remember, goodwill needs to be tested annually for impairment. But here's the kicker. It's subjective. A company can play with the estimates here to either inflate or reduce its earnings. Keep an eye on how they handle goodwill to avoid getting fooled. Warranty reserves. Companies need to set aside money to cover warranties. Look for trends. If they're adding to reserves consistently, it could be a sign that actual costs are higher than expected. It's also worth checking how the actual costs compare to what's reserved. Related party transactions. This is a big red flag area. If there are any transactions with management members or companies they control, it could mean they're doing something that benefits the insiders at the expense of shareholders. Be extra cautious here. Overall lesson, every choice and estimate a company makes can change how their financials look. As analysts, it's crucial to dig into these choices and understand if they're just playing within the rules or trying to manipulate the numbers to achieve a certain outcome. Always ask yourself, what's the company trying to tell me? And what might they be trying to hide? Finally, let's discuss some warning signs that might indicate financial shenanigans. If a company reports significant other income boosting profits, but it's from selling assets rather than operations, that's a red flag. As analysts, we need to question these anomalies and dig deeper. So, what are some of the warning signs to look out for? Here are a few. Revenue recognition policies. Look at how a company recognizes revenue. Do they use immediate recognition upon shipment, or do they have bill and hold arrangements? Any inconsistencies or aggressive policies should raise eyebrows. Inventory signals. Compare inventory growth with sales growth. If inventories are rising faster than sales, it might indicate poor management or overstated inventories. Capitalization policies. If non-current assets are growing faster than usual without corresponding growth in revenues, it might be a sign of aggressive capitalization of expenses. Cash flow versus net income. If net income is consistently higher than cash flows from operations, it might indicate aggressive accrual accounting. Depreciation methods and useful lives. Compare these with peers. Are they unusually lenient? Could this be inflating earnings? Fourth quarter surprises. Regular unexpected earnings jumps in the fourth quarter might indicate earnings management. Related party transactions. These can be a big red flag, especially if they benefit management members. Non-operating income or one-time sales and revenue. Companies might include these to mislead investors about their actual revenue-generating capabilities. If a company reports significant other income boosting profits, but it's from selling assets rather than operations, that's a red flag. As analysts, we need to question these anomalies and dig deeper. Remember, your skepticism and analytical skills are your best tools as future CFA charter holders. All right, folks, let's bring this home with a quick rundown. First off, knowing how to assess the quality of financial reporting is absolutely key if you want to make smart investment choices. Think of it like this. High quality financial reporting gives you a clear, honest picture of what's really going on in a company. It's like looking under the hood before buying a car. But here's the catch. Sometimes accounting choices can be a bit skewed or stray from the standard GAAP guidelines. You've got to keep an eye out for these biases. And don't just take the numbers at face value. Understand the story behind them. Why are they reporting this way? What's the motivation here? Is it to impress investors, manage taxes, or maybe just smooth over a bad quarter? Remember, there are tools and checks in place to encourage good, clean financial reporting. Use them to your advantage. But at the end of the day, trust your gut. Stay sharp, look out for any red flags, and always dig deeper when something seems off. If it smells fishy, it probably is. So don't be afraid to question it. Thanks for joining me today. Keep asking questions, stay curious, and I'll see you in the next session. Take care.